Hey guys, it's Steve Lamont, the founder at Elevate Realty Group, and it's been a few weeks since our last update, and today we're going to continue our talks about what is going on with the real estate market locally. Today we're going to educate you on how interest rate works. Last week, the Feds raised the prime interest rate, and every time that happens, social media is flooded, or I get phone calls from customers freaking out that, oh my gosh, interest rates are going up. And that's not necessarily what the Fed is doing. The Fed prime funds rate affects short-term interest rates. This is car loans, student loans, credit card interest. This is the rate at which the Fed charges banks to go out and loan money. Banks don't generate money on their own. They get money from the Fed to go out and loan money. Well, if the Fed is charging 2.5% interest, the bank is going to go out and put a markup on that cost and go loan it to consumers like you and me. So when rates go up rapidly, all that's doing is pushing up the cost of business lines of credit, home equity lines of credit, short-term loans like auto loans and credit cards, making it more expensive to borrow, thereby stopping people from going out and spending money. That's the whole purpose of what the Fed's doing. Now, long-term interest rates are actually dictated by the 10-year Treasury. Mortgages, treasuries, stocks, these are all investments, and each investment comes with a rate of return. So if you look at a mortgage at 5.5% interest, someone is buying that mortgage for 30 years, and they're expecting a 5.5% return on that money, and it's a very safe investment. There's nothing safer than a 10-year Treasury. Basically, you buy a Treasury bond, that's the Treasury borrowing money from you, and they're gonna pay you whatever that the current market is on that. Right now, it's somewhere around 3%, maybe 2.9. You give them your money and buy a bond at 3%, they will pay you back guaranteed. Treasury bonds are guaranteed 10 years later at 3%. Now, when the Fed is raising rates rapidly, the stock market and the bond market starts to go crazy. Money gets pulled out of the stock market, which is considered risky, and money starts to flow into bonds or treasuries because it's considered guaranteed. So when that happens, it pushes up the yield of the bonds. The bonds start to return more money as more demand flows into bonds, if that makes sense. So to break this down, when the Fed raises interest rates, it does not immediately affect or has actually no correlation with long-term interest rates. What's been happening is the markets are eroding, there's fears of a recession, so money's flowing into guaranteed or safe bets like bonds, which is pushing up the rates on long-term mortgages. If you want more information about this, another note, as of today, it's the 1st of August, interest rates are at 4.75. So rates have actually come down almost half a point since the last Fed meeting. So take that, all you Facebook the Facebook naysayers. Visit our website at homesbyelevate.com or call us at 916-436-SELL.